As investors grew more concerned that the Federal Reserve and other central banks were willing to risk a recession in order to contain inflation, stocks fell on Wall Street and throughout European markets on Thursday. With more than 90% of the stocks in the benchmark index finishing in the red, the S&P 500 dropped 2.5%. The Nasdaq composite lost 3.2%, while the Dow Jones Industrial Average dropped by 2.2%. All of the main indices' weekly gains were wiped by the wide fall. European equities plunged precipitously, with the DAX in Germany falling 3.3%. Stocks often do poorly in that scenario, according to Willie Delwiche, investment strategist at All Star Charts. It's this coordinated central bank tightening, he said. Although technology equities were the largest weight on the S&P 500, market losses were widespread in the United States. To reach 3,895.75, the benchmark index dropped 99.57 points. The tech-heavy Nasdaq fell 360.36 points to 10,810.53, and the Dow fell 764.13 points to 33,202.22. Stocks of small companies also decreased. To close at 1,774.61, the Russell 2000 index dropped 45.85 points, or 2.5%. The Fed said it anticipates rates to be higher over the next few years than it had initially projected, despite lowering the pace of its rate rises. Investors had hoped recent indications of some easing in inflation would convince the Fed to ease up on the brakes it has put on the American economy, but they were disappointed. At 4.25% to 4.5%, the federal funds rate is at its highest point in 15 years. By the end of 2023, the Fed's officials predict that the interest rate will be in the 5% to 5.25% range. Prior to 2024, no rate reduction is predicted under their projection. The yield on the 3-month Treasury fell to 4.31% but is still higher than the yield on the 10-year Treasury. This is referred to as an inversion and is regarded as a clear indicator that a recession may be on the horizon for the economy. According to Quincy Crosby, chief global strategist for LPL Financial, the stock market's reaction is now pricing in a recession and rejecting the notion of the soft/softish landing that Fed Chair Jerome Powell mentioned in his speech last month. According to Delwiche, Wall Street's concerns about how company earnings may perform in a recession have increased as a result of the possibility of further Fed rate hikes. At the same time that certain sectors of the economy, such as employment and consumer spending, continue to perform well, the central bank has been working to reduce inflation. Because of this, it has become harder to control rising costs for everything from clothing to food. The government announced on Thursday that fewer Americans filed for unemployment benefits last week, indicating that the work market is still robust. Another survey, meantime, revealed that November's retail sales were down. Following a strong increase in expenditure in October, there was a retreat. Similar to the Fed, European central bank officials stated that additional rate hikes are on the way and that inflation has not yet been contained. Matt Ott and Elaine Kurtenbach both contributed to this article.